China is no longer able to hide the silver accumulation footprints, and liquidity providers assess they have cornered sufficient global silver supply to let it just run higher. The cartel gamed that. However, this synthetic overshoot of an undersupplied physical market has been jumped all over by China. As a result, liquidity providers expect a physically driven rally to force the cartel, silver shorts, to move to short cover into any further related automated stock market selling.
In a striking development shaking up the precious metals landscape, silver is now trading at levels that suggest it is profoundly undervalued relative to gold. The gold-silver ratio, an important indicator of relative value between the two metals, has surged to an unsustainable 101 to 1, recently even touching 104 to 1. This means it takes over 100 ounces of silver to equal the value of just 1 ounce of gold, a ratio far above historical norms that typically range between 40 to 1 and 60 to 1. Such extremes have historically preceded major price corrections, pointing to significant upside potential for silver shortly. Renowned analyst Andrew Maguire notes that the physical silver market is flashing warning signs of scarcity, with spot silver prices now consistently trading above futures contracts, a situation known as backwardation. This flip from an 80-cent discount to a growing premium indicates strong current demand and a shortage in immediate physical supply. In fact, the May futures contract at one point showed an 82-cent backwardation, with the spot price almost a full dollar higher than futures. This market structure is often interpreted as a signal of extreme tightness in physical inventories. This situation cannot be sustained indefinitely without triggering price movements to the upside. A major factor behind this shift is the surge in physical buying across Asia, particularly in China, where large spot purchases increasingly counter the traditional dominance of paper short sellers. Maguire highlights that strong demand also comes from India and Saudi Arabia, adding further pressure to an already tight supply chain. Technically, silver has been shadowing broader stock markets, but is now beginning to decouple and show strength as monetary demand picks up. Meanwhile, efforts to suppress silver prices through synthetic selling show signs of collapse. With cash-settled futures contracts now trading far below physical delivery prices, the disconnect is reaching what many analysts describe as capitulation extremes, a condition that often precedes a sharp upward repricing. If current trends continue, silver may soon reassert itself as an industrial metal and a monetary force with renewed global relevance. Now, we present the clips from Andrew's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Underpriced is unbelievable. As we picked up again in our last episode, China is no longer able to hide the silver accumulation footprints, and liquidity providers assess they have cornered sufficient global silver supply to let it just run higher. 2 weeks ago, spot silver flipped from an 80-cent discount to trading at a consistent premium to the May futures contract. Now, the clues are there as a trader, you'd know, well, hang on, you mean the spot price, in other words, it's backwardated. So these synthetic futures backwardations to spot reveal the cartel's paper to physical disconnect, and it's being reeled in very large size. The cartel has aggressively gamed the COMEX-centric silver futures correlation to the falling stock market. So obviously we've seen that correlation, and we've seen it in the charts as well, and where we see silver auto sold. And that's nothing to do with margin calls, much like gold where it had margin calls. They had no, this is a correlation. So the cartel gamed that. However, this synthetic overshoot of an undersupplied physical market has been jumped all over by China. As a result, liquidity providers expect a physically driven rally to force the cartel, silver shorts, to move to short cover into any further related automated stock market selling. Now, looking at silver, liquidity providers assess that the Friday, April the 4th, last-ditch cartel attempt to protect shorts ahead of a physically driven spot silver upside breakout. And we'd seen that it was getting very, very close to breaking out. And we saw this massive counterintuitive, and we saw this as a last-ditch attempt. And the clues are all there. I mean, it's so clear that this is running too thin to continue. The clues are there, commencing with, this was an 82-cent May futures contract backwardation, meaning that the spot market was trading at close to $1 higher than the May futures contract, illustrating, I mean, this low here that we witnessed here, the actual fix that followed that was actually above 30. And even then it was backwardated. And from this moment here, spot has been trading at a premium this whole way up to futures. And it's telling us silver is about to break out. And it's still commanding today, still commanding a 6-cent premium over the May contract. And since then, so spot silver evidence an unrelenting global spot premium. This has not faded. It's clear that Asian, primarily Chinese, physical silver buyers are steadily overcoming cartel short sellers. Now, while there's a fight at every round number, and we see it again, the reason that I haven't got this at 33, which is what it should be in the futures, is because the spot market is trading at right now at a 4-cent premium to futures. So really, as far as the myopic futures guys are concerned, this is all they see. What they don't see is a silver market that is strong, very, very strong. As the spot and futures gold markets continue to rally into all-time highs, these counterintuitive silver capping efforts are stretching an unsustainable. We've seen it at 104-1 gold-silver ratio, and we're still seeing it at 101 today. This is unsustainable. It's telegraphing that this deeply backwardated cash-settled silver contract versus deliverable spot is reaching capitulative extremes. And just as a note, while the cartel's been able to cap the spot silver fix sub 33 today, we can see very large spot buyers are active in India, China, and Saudi.
So while we expect the ebbs and the flows of tariff talk to create additional volatility in both gold and silver, these shorter-term higher pricing levels ultimately lead to the larger market weighing machine to reveal both gold and silver are underweight on this weighing machine. It's really straightforward.
The global gold market is facing a significant supply deficit, currently at 900 tons annually, and projected to reach 1,200 tons by Q4 2025. This imbalance is driving prices upwards, especially as China's insatiable demand for gold creates a one-way metal flow into the country. Gold entering China is effectively removed from the global market, contributing to a permanent reduction in supply. Based on the quantifiable supply-demand dynamics, this has prompted major bullion banks to revalue gold by $500 to $1,200 higher. In response, physical gold premiums have widened, reaching 6.7% in April 2025, the highest since 1979, signaling extraordinary demand for tangible gold versus paper contracts. Major financial institutions like Goldman Sachs have accelerated their price targets, with projections now forecasting gold prices between $4,200 and $4,800, up from their previous 26 targets. According to Andrew Maguire, this tightening of supply and rising demand only adds to the ongoing upward pressure on gold prices. China's long-term strategy for gold accumulation is a critical component of this evolving market. While the country's monetary gold purchases are not officially included in its reserves, China's total gold holdings, including state-controlled entities and military reserves, could be closer to 40,000 tons. This massive accumulation is designed to fortify the digital RMB as a global settlement currency and increase China's influence on the global financial stage. The Shanghai Futures Exchange, launched in March 2024, has further intensified China's role in the market, contributing to a surge in gold prices and significantly boosting the country's registered gold holdings. This shift in China's gold strategy could reshape the global gold market and deepen the supply constraints already driving higher prices.
As an example, and as was widely reported by the likes of Zero Hedge, etc., Deutsche Bank global head of FX, George Stavros, argued that despite President Trump's wavering on tariffs, the damage to the US dollar has already been done. And quote, I'll just quote him, "The market is reassessing the structural attractiveness of the dollar as the world global reserve currency and is undergoing a process of rapid de-dollarization." He's not alone in saying that, not even accounting for the PBOC's push into gold. Stavros estimates gold could rise to 3,900 average 2026 price. Now, this is not out of kilter with Goldman Sachs et al. As Deutsche Bank summed up, a new geopolitical dynamic and risk to the dollar's reserve status furnish a context which suggests that a heightened pace of gold reserve accumulation is likely to continue, translating to fourth quarter gold price of 33.50 in sync with Bank of England, Bank of America at 33.50 and Goldman Sachs at 3,500 fourth quarter. That was before these guys have updated their projections. Now, I'm just quoting really what is not even a gold guy. This is talking about an FX guy here. However, the expectations of a wall of physical and ETF buying competing with official gold repatriation demand drove several bullion banks, including Goldman, to upgrade their spot gold targets to between 32.50 to 35.20 in 2025. However, ETF demand could conservatively evidence a run into 4,500 to follow by the first quarter of 2026. This is evolving. It's changing daily. It's upgrading daily. More immediately, unless we evidence a U-turn, the ramp up of trade sanctions against China is fast morphing into a financial war. And as was conveyed by Beijing on Friday, and I think this is what they said, given that the current tariff level, there's no market acceptance for US goods exported to China. If the US continues to impose tariffs on Chinese goods exported to the US, China will ignore it. What kind of a dislocation is going on here? So let's have a look.
Now, sometimes it helps to just look at the very short-term action. Now, really, I'm not really trying to focus on the short-term action, but we're trying to illustrate some of the footprints. And this is where we recorded the last episode between the AM and the PM fix. That was here on the 2nd. And this is where, again, we're recording between the AM and the PM fix. And really, the spot of the futures market has just opened for business. So this is a futures chart. So essentially, we're looking at what would be equivalent to the 3,300 spot level, actually being there's about a $16 premium for the futures contract, which expires at the end of May. So that would be a carry cost. That would be about right. So anyway, this is the reason I'm bringing this up is because sometimes it's important to look at this entire, what we see is a constant. Sometimes we mark these pits. Asia buys, West sells. Asia buys, West sells. And it constantly, we see it time after time, but it's starting to fail. And we see that every single morning without fail. Asia buys, the West sells. They're getting overrun. And I think this is important sometimes to look at the smaller footsteps to see exactly how they translate into the bigger footprints. And China has long ago taken steps to hedge such an inevitable financial war, basically which is a necessary step to hedge the expected military war. Xi has been openly discussing for several years now, and we've looked at these. We've actually quoted these military generals. This was 2 years back and 3 years back, where they were talking about, we expect a military war. We're getting ready for it.
This could be a financial war just as easily. Now, trade sanctions have accelerated the PBOC's ongoing process of selling US treasuries and then using these foreign exchange dollars to buy gold in large size at each and every global benchmark AM and PM gold fix. And it doesn't matter whether we're up or down. Every single fix, China is on the buy. And not just China, but also all the Asian banks. It's the alchemizing of these dollars into gold.
Silver, often overshadowed by its more celebrated counterpart, gold, is gradually gaining attention as an undervalued asset poised for significant upside potential. While gold has historically been the go-to safe haven for investors, silver's dual role as both a precious metal and an industrial commodity makes it uniquely positioned to outperform in the coming years. As demand for green technologies, solar power, and electric vehicles continues to soar, silver's essential role in these industries is becoming more apparent. Despite this, silver remains underappreciated compared to gold, with many investors still underestimating its long-term value. With the growing industrial demand and its historic role as a store of value, silver is set to capitalize on the shifts in global markets. Silver will likely surge in demand as more investors begin to recognize its potential, especially if its historical relationship with gold strengthens. Given its undervaluation, silver promises to outperform gold as the world's economic and financial landscapes continue to evolve. That's it for today. Share your thoughts on Andrew's in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.